start. So welcome. Good morning, everybody, and thank you for joining today's session. I'm Sean Gibb. I'm the Events and Marketing Manager at Pro Manchester, and I'm delighted to welcome you to the review of the M&A funding market in the Northwest. Views from a cross-section of local funders, hosted by Cole Associates Corporate Finance LLP. Following today's session, I'll send out a post-event email, which will contain any post-event collateral, any links to find out about more information on this and other Pro Manchester events, and a link back to the recording. Just a few points of housekeeping. Please be aware that this session is being recorded. Feel free and please do make use of the chat function. We want you to ask questions, make comments, observations, and we'll address those towards the end. As I have said, please do keep your microphones on mute for the time being. And without further ado, I will hand you over to Jeremy Cole, partner at Cole Associates.
Thanks, Sean. Thanks a lot. Good morning, everybody. Welcome to the webinar. I think it's going to be a really interesting conversation. We've got a fantastic panel that covers every aspect of the funding markets. We ran a similar event, Paul Elby and I, in October 2018 and 2019, a couple of the same panel members today. So it's going to be really interesting to compare and contrast with the new deal doing world that we live in today. For those who don't know me and my firm, we're lower mid-market corporate finance advisors. We advise on acquisitions, buyouts, growth capital, company sales, based in Manchester. If you were to ask me about the last 14 months, I've been pleasantly surprised. I think a lot of that's down to how much funding was in the system before the pandemic, and I think that's something we'll hear about from the panel today. If you have any questions, then fire them in, and we'll try and deal with them at the end. I'll get the panel to introduce themselves briefly in a moment, but just get Paul Elby introduced first. Paul, you looking forward to an interesting session?
I am indeed, Jeremy, yes. Thank you. Good morning, everybody. I'm a partner in the Manchester office of DAC Beechcroft. If you don't know us, we're an international law firm. We've got 2,500 people worldwide. My focus is M&A, venture capital and private equity. I'm part of a 40-strong national team of corporate lawyers that covers the broad spectrum of corporate transactions. Our clients include PLCs, institutional investors, all the way through to OMBs and most points in between. So just to give you a bit of a flavour of the last 12 months, I'd echo what Jeremy says. I mean, if you'd have asked me at the outset, I'd have predicted that we were going to have a repeat of 2008. A real slowdown of transactional activity, but it's been pleasantly surprising. And in the last 12 months, I mean, we've acted on an acquisition for EMIS Group, a listed company of a pharmaceutical software business. We've done a couple of funding rounds for health tech scale-ups for the provider of an order and pay app into the restaurant and cafe business. We did the first take private of lockdown. We've currently got a lot of deal activity going on. We're in exclusivity now with PE following an auction process on behalf of a software business. We're working on a couple of clean energy transactions. We've got a sale in the telecom sector. So all very positive and, as I say, somewhat surprising given the context of the pandemic.
Yeah, brilliant. Jonathan, legend of the private equity and venture capital sector.
I'm not sure about that, but I've been at it, if that's the right expression, for over 30 years, doing venture capital private equity. Now with Mercia, former PLC director, former CEO of Enterprise Ventures that some may remember, which grew from about 20 million under management to 250 million. And Mercia today manages something like 900 million EIS, VCTs, funds. And we've been investing heavily with CBILS, Future Fund and what have you. So we've had a very busy time, about 139 transactions between March and December last year. Not the biggest amounts. Obviously, there are people that out invest us in a day. in the city, but SME directed, regionally focused investments.
Yeah.
That's me.
Brilliant. Thanks, Jonathan. Stephen?
Yeah, good morning, everyone. Thanks, Jeremy. So I joined Petrova Commercial Finance as a sales director back at the end of 2019. It's been an interesting start to some of my life there. I have a focus on originating and structuring funding solutions for UK businesses. And for those who aren't aware of us, we're an independent asset-based lender based up here in Manchester. Typically work with owner managed and PE-backed SMEs, providing funding solutions for a sort of variety of transactions and various situations. Typically looking at facilities of sort of 1 to 15 million is where we tend to operate. Prior to joining Petrova, I qualified as a chartered accountant at EY. I've spent just over 13 years in the sort of restructuring and transactions advisory space there, and during that time I advised a variety of stakeholders and have a pretty broad experience of both solvent and insolvent transactions from that time. So working on a lot of local opportunities, but also on national projects such as the House of Fraser and things like that, which are maybe more household names. Also spent 12 months on secondment at a business support unit of one of the major clearing banks as well earlier in my career. So hopefully I can give a bit of a view from an asset-based funder perspective, but also from a restructuring perspective, which is probably quite relevant at the moment.
All right, cheers, Stephen. David, returning panel member for the third time.
Yeah, back for more. Morning. Yeah, not been in the game, not been at it quite as long as Jonathan, but in private equity for 22 years now. It makes me feel very old. The last 5 or 6 years at Elysian Capital, where we're focused on mid-market buyouts in the deal size 20 to 100 million. Approaching the market slightly different to, I think, most of our competitors in that we're very entrepreneurial, very owner managed. Half of our partners are genuine business people who've had proper jobs before, other than in finance. And we're investing quite a large chunk of our own money to generate a true alignment with the management teams we back. And that seems to be working quite well. That's me.
Brilliant. And last but not least, Paul.
Yeah, morning all. So yeah, I'm Paul Doviniuk. I lead the deal origination and structuring activity in the North for Cable International. I've joined very recently following 4 years in BGF's investment team in Manchester, providing equity funding and growth support to SMEs across the Northwest. Prior to that, I spent 10 years in KPMG's Manchester office, most of that in the corporate finance M&A team, working on private equity and corporate transactions. For those less familiar with Capel, we're a cash flow lender. We provide term loans to the medium and larger end of the SME market, so predominantly profitable businesses with a turnover range of between 1 and 50 million. We've got 2 core products, both which we think are differentiated and designed to fill existing gaps we've seen in the funding market. Our first product, which what we've been lending for the last 2 years or so, which we've lent about £130 million to date, in loan sizes of between £500,000 and £5 million. And I suppose 2 distinct features of that product is it's very long term, 5 to 8 year repayment profile, most of that at the upper end, 7 or 8 years. And secondly, it's completely unsecured, so no security or personal guarantees or equity warrants or anything, which means it complements existing banking facilities really well with a high degree of simplicity. We think that's going to be increasingly relevant over the next next few months and couple of years, particularly with an ability to lend across and alongside CBILS loans, and particularly as the high street banks become more cautious for SME transactions in general. And last month we launched our second product as well, which is exclusively to fund management buy-ins. There's a structural underfunding in that part of the market, particularly from a debt perspective, and we expect to see increased activity in management buy-ins as a genuine alternative exit option for sellers going forward. So that's me and Capel at high level.
Okay, thanks, Paul. So, Paul, do you want to head off with the first question?
Yeah, sure.
Indeed. So it's going to be confusing having 2 Pauls. So, I've actually got the first question lined up, and I was going to go to you, Paul, to begin with. So, really, what we wanted to do is just focus on. Jeremy and I had touched on it that it seems to us, I mean, the market's been resilient, and possibly one of the reasons for that is that unlike 2008, I mean, there does appear to be more funding around. So the question was really, from the supply and demand side, what's the market like? Is there money out there for investments? What's the appetite of your fund? And are you seeing the demand?
Yeah, sure. So from my perspective, in terms of sort of the bigger picture, I think when you look at the data as a whole for deals and M&A across the region, absolutely agree. There's been a great degree of resilience and activity nationally and in the region. And in my view, that's a really good barometer for the funding appetite and availability and demand in the market. To give you a perspective on Capel's part of the SME market and from a debt angle in particular, on the supply side, has there been adequate funding available for M&A activity? Short answer for me is yes. While not designed as an M&A tool, government-backed loan schemes, namely CBILS, has probably underpinned a lot of the debt supply for acquisition demand in the SME market. Other transactional activity sitting largely outside of CBILS territory, mainly buyouts, have also been reasonably well supported by lenders, including Capel, once the demand and confidence came back into the market during the latter half of last year. In reality, the supply of funding for buyout type activity was probably largely untested in the first phase of the pandemic. I think largely due to much subdued activity. I think acquirers and funders were reasonably well aligned in requiring a pause in activity to appraise, firstly, the impact of the pandemic and then the resilience of target businesses to the pandemic. But as a whole, has funding been available and accessible? I think so. In terms of the question regarding demand, I'll break that down into two. Have businesses demonstrated demand for growth and M&A funding? Yes, I believe so. Have businesses in general gone on to make that investment spend for growth and acquisitions right away? Probably not, or not yet, at least in large part. And I think CBILS has been a major factor in that too. From what we've seen, businesses have tapped into support schemes, whether they've needed them or not. We've witnessed a huge number of businesses, good businesses, actively trying to secure CBILS loans and park them onto their balance sheets, whether they use them or not. So there's been plenty of finance which has been accessed by businesses for growth, for investment and for acquisitions, but they haven't intended to deploy it right away. And instead that's created a bit of a war chest for an option rather than for a very specific growth requirement that needs financing immediately. I think the decision on whether they will use it or not is going to be largely determined in the next 3 to 6 months for a lot of businesses who took on these loans last summer. So I guess that's the perspective or the observation I have from Capel's perspective. To answer your question on our appetite, it's remained steadfast throughout the pandemic. We still have a very large appetite to support M&A activity. Going into the pipeline, activity in pipeline was very buoyant, roughly a 50-50 split between growth capital and transactional requirements. I guess that balance for us in particular shifted more towards buyouts over the last 12 months, predominantly as Capel's isn't CBILS accredited. That's an intentional decision we made, given how we work in tandem with other lenders who we expected to be the primary source for CBILS requests. So our appetite has remained constant, I guess, and we have continued to do growth and acquisition funding, but we've seen CBILS sort of fund more than their market share in that part of the market. However, the plus side for us is CBILS has ended, and following that, we're seeing more and more demand across the whole piece for corporate acquisitions, for in addition to buyout activity, and we've got very large appetite to lend into that space and support those requirements. I think furthermore to that is on buyout activity in particular as well, we've been a very attractive option for borrowers, not only because of our appetite to actually fund the transactions, where others have potentially retrenched or some have been exclusively focused on CBILS activity, but we've seen a demand for deliverability and execution, particularly as we got closer and closer towards the budget for obvious reasons. And that's a major strength of our model. The fact that we can move quickly, the fact that we're unsecured, and the fact that we can complement existing CBILS loans for businesses who need more capital for growth probably puts us in a really good place to support those type of opportunities going forward.
Thanks very much, Paul. David, could I ask for your experiences?
Yeah, I think on both the supply and the demand side, it's gone in a way that none of us could have predicted 12 months ago. You go into a global pandemic and you expect the world to stop for a while, but actually what we saw was the finance world bounce back extremely quickly, and some could argue prematurely. Look at today's headlines: the FTSE 250 is at an all-time high, the US markets are an all-time high, and I think all of that is driven just by the supply of funds and low interest rates. Jonathan might come on to this, but all it takes is a few tweaks on interest rates and inflation to kick in, and suddenly the supply might not be quite as robust as it has been in the last year. We're a fortunate beneficiary of that. We've got a very good deal track record, but we raised a new fund last year despite the pandemic, 325 million. But what we saw, particularly in the autumn, was prices for buyouts being at record highs. You look at the multiples paid on average last year, it's about 12 times EBITDA. You go back, in Jonathan and my world, you go back 15 years, the average would have been 7 times EBITDA. So almost a 50% premium on where they were 15 years ago, despite still being in a global pandemic. I think the harder question is what's going to happen next. And I think despite the fears of further coronavirus issues, and despite the fears of asset valuations, I think the supply of capital is just going to continue. So I still feel very buoyant about the future. And the demand has also followed. And we saw quite a blip actually over the last 6 months with fears about capital gains tax, which proved to be unfounded. Lots of vendors looking to take some cash off the table, or owner managers looking to take cash off the table. Lots looking to sell, actually, who said, I've lived through the uncertainty of Brexit. I don't know what next for me and the business. And now we've got a global pandemic and there might be tax changes. I'll cash in now and walk away. So I think it's been volatile, but actually it's been far, far, far more buoyant than I think any of us might have thought if we'd asked the question a year ago.
Thank you. Stephen, any different experiences in your line of business?
Yeah, hopefully I can give a bit of an insight from an ABL side. So, echoing the points made, I think businesses certainly had access to a range of funding options, both those that existed pre, but obviously the additional government-backed solutions that have become available as well. From our point of view in the ABL world, I think following that first national lockdown back in March last year, I think funders in our space naturally dedicated attention to supporting their existing clients initially, whether that's to deal with economic and market challenges, but probably as importantly to not always be too negative, also opportunities. So businesses who could diversify to support the fight against COVID, or those that were experiencing increased demand. So, sectors like home improvements, I guess, is a good example of that, where there was actually a benefit, if anything, from that lockdown situation. But despite all of that, there was certainly a continued appetite to fund new clients, and that included ourselves. From our point of view, we're probably at the lower volume end of the market, and we certainly noticed our clients appreciated and benefited from a more hands-on approach. We were sort of initially able to support through weekly video calls and that sort of thing. And I think what we saw was a lot of our clients just hadn't experienced a downward cycle and didn't really know how to access that additional support that they may need. So that was something I think was quite key early on. I am aware of other businesses who maybe didn't quite have that access to the relationship manager, whether that's due to larger client volumes or just increased demands on people's time, etc., which was a bit of a challenge. And we're probably closer to our clients now than we'd ever been as a result of that. So that probably deals with the supply side. On the demand side, I think with the abundance of government-backed funding options, and alongside all the softer HMRC deferral and job retention support scheme, there was certainly a reduction in demand for our core sort of asset-backed facilities. Existing clients were certainly using less of their facility, and I think echoes a point made earlier that actually there was a desire to take C-bills as a sort of a preference option and have that on the balance sheet, and we were finding that was actually being used at the expense of using their existing asset-backed facility. But I'd say probably since autumn last year, we've certainly seen that as businesses adapted to, I guess, trading during COVID and during lockdowns, we've certainly seen a revival and an increase in demand for transaction-led funding. I think that demand has been met by suitable supply. I think a lot of funders in our space probably keen to catch up on 6 months of challenging times and get some lending out the door. From our point of view, we've completed 3 MBO transactions this year in Q1. And again, a point I made previously, I think the timing of that was certainly partially affected by the CGT speculation, and we sort of found that that has created a bit more urgency in certain situations. But I think outside of that, we have seen transactions generally taking a little bit longer to progress, taking a little bit longer than we would normally expect. And maybe that's just more attention being paid to the diligence process and understanding that business plan to recover out of the back of the pandemic and the lockdowns. But I think in general, recent trends show that, you know, there is a good demand, and that demand is continuing.
Thanks, Stephen. So, Jonathan, I mean, so far it's sounding pretty positive. It sounds like Roadrunner, despite all his speed, is taking a bit of time to get to the edge of that cliff you predicted that he'd go over back in 2018. You're still predicting that that's coming?
Well, for those who weren't there, I, with my great IT skills, waved a picture of Roadrunner in front of the audience in, what was it, October 2019, saying there was an air to the markets then, and it's hard to remember now, but of sort of unreality, and they run off a cliff, the Roadrunners, and their legs keep going, and they stay in the air for a certain amount of time, and then suddenly they realize that there's nothing beneath them and they drop. Now, clearly that hasn't happened, and I didn't forecast a pandemic, although I was, if you like, probably underestimating the power of the wall of money. And it's not just private money. I think the key thing for the last 12 months has been the wall of state funding that's gone in. And I'd be surprised if any of the investors here hadn't had an impact from C-bills, etc. It's difficult to put orthodox lending into the market if you've got a C-bills alternative. You take it, as some have said, and you stick it on the balance sheet, and you use it if you want it, if you need it. So I certainly didn't predict the pandemic, and I certainly don't think that things. I think what has happened is that the ball, the can has been kicked down the road, and if you like, I've moved from Roadrunner to Transformers for those who are cartoon aficionados, because I think that adaptability, the ability to move fast, move aggressively, and change your spots is going to be the order of the day going forward. So it's not been the end of the world, but it might be the end of the world as we know it as things shake down. And as that state funding either is limited or is withdrawn, which inevitably sooner or later will happen. I'll talk about other threats further along the line if you like.
Okay. Do you want to go through your slides, Jonathan?
Well, let me just see if I can do it first of all. It's not responding. No, it's not responding. Oh, share, that's what I have to do. That's there, right. So we have, there he is, the Transformer. Can people see that? This year's cartoon is Transformers. It's not the end of the world, as I've just said. One or two other issues that have come along and are now much more entrenched than even October 2019. Fourth blob down. COVID's changed a lot. It's accelerated trends in retail and digital. We know about that. We know about what's happened on the high street. It isn't coming back anytime soon. And it's going to be very, very interesting to see what happens, see if retail does revive in any sense. ESG, green and emissions issues are now real, and everybody's taking them very, very seriously. They're not just talking about them. Obviously, travel and hospitality have been completely hammered, and it's going to be very interesting. I have some investments in the travel area, and it's just every time you set a milestone, it seems to be pushed back. Other points I wanted to raise: underlying demand seems to be strong in certain areas. What will happen? Currently, property prices seem to be strong. We've heard about deal values, multiples. what's happening in the property assets, commodity prices areas. And another trend, bringing back production. We're seeing it obviously in pharmaceuticals, the vaccine production. We're also seeing local supply lines. We hear about chips, computer chips, and the problems to automotive manufacture where they can't get them from China, whereas they basically sent all the production over the last 20 years. It's going to be a trend to bring certain local supply lines back into our local markets. The other one is the continued utter belief in tech. That's true tech. And obviously certain tech winners have been huge winners. It's interesting to take Deliveroo as an example, 25% down post-listing. I would argue that's not a tech business. It's just got a clever app and it works on, I mean, it couldn't be less tech, could it? People on bicycles working for peanuts. So, you know, in a sense, what is true tech? I'm not saying that tech is going to fade away, but I think people will be far more alive to what true technology businesses bring forward. And of course, the wastage in the sense that so many businesses that are invested in with a tech winner, so-called, don't deliver the goods ultimately. So it's going to be, that's much more venture capital, much more risky, and it will be proved to be risky over times to come. So is that all right for now?
Yeah, that's great, Jonathan. Thanks a lot. Okay, one area I'd like to get your views on, maybe a couple of you, is how the transaction process has changed out of necessity during the last 14 months and how some of those changes might continue in some shape or form when all the travel restrictions, etc., are removed. So obviously we're on Zoom today. We're all very familiar with transacting from beginning to end virtually. I think a lot of transactions have been done from beginning to end without any physical meetings. And let's face it, 18 months ago, nobody would have believed you if you'd suggested that could ever possibly happen. So that's been out of necessity, and the technology's been great, but maybe I'm a little old-fashioned. I'm a massive believer in face-to-face communication, both in right at the networking end of things, developing as a professional in Manchester, being able to go out and grab a coffee or a beer with a peer, all the way through the deal process, the negotiations, and through to completion. And I suspect, as Jonathan's just mentioned, what's happened in the last 14 months has been the acceleration of something that might have happened over the next 5 or 10 years. And the challenge is, what are the best bits of that we should retain, and what are the bits that we only did out of necessity and we want to get back to some good old-fashioned practices. I mean, Paul, as in Paul Dolyniuk, have you got any views on that?
Yeah, sure. I think being honest, from a capable perspective, it was largely seamless for us operationally. I think most of our process we can undertake remotely, and we do adopt a large degree of standardization when it comes to our credit process and documentation, etc., which has enabled us to remain sort of efficient and active. From a practical perspective, I agree, Jeremy. Of course, it's always better to sit across the table for management teams and advisors, and but I guess the majority of what we need to do as a funder can be achieved by video conferencing, or at least in a socially distanced environment when those circumstances are allowed. I think by and large, most people were already well equipped for remote working and probably didn't know it. I agree, video conferencing platforms and software and technology have been robust, and adoption of those by all parties in a transaction during lockdown was particularly quick indeed. Albeit there's still a need to constantly remind people they're talking on mute. That hasn't subsided yet. And we've been through a sort of a bit of a transaction process of our own as well, in the context of partnering with Shawbrook Bank to launch a new product exclusively for MBIs. I mean, that was a 5-month process from start to end, and has been achieved sort of entirely remotely, really, through lockdowns, and gave us a good experience for us in terms of Capel and how we achieve our own strategic aims. But I guess looking across the M&A market, I think the practicalities and challenges will definitely vary depending on your role within a transaction, and where you sit on the funding spectrum as well. So I think if you're a secured lender funding largely from assets, I think your challenges are probably less around the ability to meet management teams and in person, and more about the ability to assess and value the asset base in the business. Whereas from an equity perspective, assessing the quality of a management team and developing a relationship with them, which is typically required to be done over a period of time, is undoubtedly one of the most important aspects of a transaction and an investment decision. So I think Teams and Zoom, whilst good in large part, they've only been a partial substitute for that. And I don't think there'll be many deals in the market where meetings have been entirely and exclusively virtual. There are just some human aspects of that you can't replace. I think on the flip side, I think video calls to an extent have allowed us to have a bit more insight into people's personal lives and home environments. And that's been a good way of stimulating discussion, sharing stories and building relationships, personal relationships, sort of in a different way. In terms of post-lockdown, I still think many aspects will return to a in-person presence, particularly around relationship building, advanced negotiations, on-site due diligence, the like. But I also believe that the advancement and acceleration of adoption of digital systems and processes will see a lot of that retained to generate significant efficiencies during the transaction process. I think you'll see hosting of less critical meetings over a video conference, saving time and travel and cost for multiple parties, and that should enable meetings to happen sooner with shorter lead times to get meetings in diaries, and signing of documentation or things like that could all lead to sort of a faster and more efficient deal process and transaction activity going forward. I think in terms of networking and the impact on the city centre, I personally can't see there being a lasting negative impact or effect on that. I think particularly in the Northwest, which is a close-knit community, it's people and relationship driven. And I think everyone, we work closely with a lot of advisors, and everyone I speak to from an advisory perspective or a funding perspective is just looking forward to getting back to the networking scene and attending these type of events in person rather than over screens. And I guess judging by the number of coffees and beer meetings I've provisionally committed to with people once lockdown ends, I just can't see networking or meetings in the city centre dissipating long term.
Sure, yeah, I agree. Well, I certainly hope that's the case, Paul. So David, just picking up on what Paul was saying about the difference between a sort of asset-based lending appraisal process and how that can be dealt with remotely versus the if you like, greater subtleties of the private equity decision. How have you found the last 12 months or so? How do you see things evolving once the restrictions are all lifted?
I think I'd agree with most of what Paul said there. Technology has enabled everybody to work, I think, extremely efficiently, and life to go on very well. But what it has actually, I think, made a bit of a push on, which is a shame, is finance becoming a little bit of a commodity, and you lose that sort of personal aspect of finance, that it just becomes about the numbers. And we saw a few deals completed last year where these are deals of 100 million sterling to 150, where the private equity house never met the management team. And the advisors were very happy with that because they were just sort of pushing through a deal very quickly and almost like a matchmaking type process. And the technology enabled that to work brilliantly. I see a massive downside in it though, because you live with that private equity partner for the next 4 or 5 years. And actually it's the people, it's the chemistry, it's the rapport, it's really getting to know each other properly that is important. And I think there's a lot of management teams that'll be waking up over the next 12 months thinking slightly, we now know the people that we've got into bed with that we didn't know before. And whilst it worked seamlessly and efficiently, maybe we would have looked at it in a different way. So literally over the last few weeks, we've got back on site with management teams, and it's so much better than over Zoom. Zoom, this works great, doesn't it? But going to see a factory, going to see a manufacturing site, walking around, having a beer afterwards, getting to know a bit about their lives, and you just cannot do it on Zoom. You cannot replicate that. And actually, whilst it's important for us to judge the management team and understand the business, it's equally important for them. And I think that's been overlooked a little bit, actually. I think management teams have been slightly neglected and just kind of passed around a little bit too much by our world.
Interesting.
And I think that will reverse. And I'm hopeful it is reversing. That'll get back to the old ways. I agree with you. Sort of meeting somebody, having a beer with somebody, it makes a world of difference.
Yeah, I think the other thing that some large professional firms have lost a bit of sight of is your average manufacturing business has stayed open throughout, maybe other than a couple of weeks they were closed back in March last year. They obviously have to be in the office or in the factory to produce what they're producing. And if you're talking to business people who run some sort of manufacturing process like that, their default expectation is that you would still meet in person. If you were, say, pitching for a sale mandate or to make an investment, they would be disappointed if you refused to come out of your home to come to a face-to-face meeting, obviously with the right social distancing protections. Whereas I think let's call them the professional people like us folk, where you're used to working in offices in the centre of Manchester, the default expectation is the reverse. It's that you stay at home until your employer tells you, we really want you back in the office now. And I think I've seen situations where the fact that we've been more than happy to come out and meet in a safe environment, but at the company premises face to face, has been a competitive advantage because some competitors haven't been allowed to do that or able to do that. And I think there'll come a tipping point over the next few months after the middle of June, where that kind of default expectation will shift back to face-to-face rather than virtual in a lot of situations. And it was quite interesting to see the difference between the press releases that Goldman Sachs and PwC have put out in the last couple of weeks, where I think the MD of Goldman Sachs London office basically said, if you're not back working in the office 20 hours a day after the 21st of June, you're fired. Whereas PwC have taken a much more conciliatory, flexible working approach. And I guess those two positions say as much about the culture of those organisations as anything else. I'm being a bit cynical about the Goldman Sachs guy. But my main bugbear is, and it's difficult to measure, but all the subtleties, particularly for young professionals, around the development and the coaching and the mentoring that you get face-to-face in an office environment. Yes, you can get that virtually, but it's nowhere near as efficient as everybody being in the same physical space. And I do think, particularly from young professionals' point of view, the sooner people get back into an office environment is the sooner the better. I mean, on that question about the impact of the pandemic, etc., and working practices, Jonathan, Stephen, you got anything briefly to add?
I agree about new employees. We've got 22 new starters since the pandemic who I've never met. Now I'm organising a series of walks, because they are legal, aren't they? And we're going to just literally go out and walk and talk, and at least get through the basics. So there's a lot of nonsense been talked about working from home. It's not efficient, and I can actually see deals that we've lost, not pursued. Frankly, I don't think they've been done elsewhere because we just couldn't get our heads around it. And if you're paying a 12 times multiple, the sort of EBITDA multiples are just eye-watering. You get that. I've sat on over 100 investment committees in that time. And the problem is that you can't get a sustainable figure that you can rely upon for 2020. And the 2021 forecast is in a similar category. Get that wrong by even a small margin if you're paying double-figure multiples, and you'll never get your money back, never mind, the growth that you're talking about. So I think valuations are a key issue here. And in a sense, we're aping the main markets, the wall of money.
Okay, yeah.
Next to you, Jeremy, I think I would say that I'd like to hope there's a balance going forward in the whole efficiency of being able to utilize the technology we've all got used to. I certainly think there are certain situations where maybe it's an early stage meeting where a long travel to London or elsewhere maybe could be avoided, and whether that helps people with a bit of work-life balance, whether it's better for the environment and other factors, and maybe just more efficient. But I think you're right, I'd echo what everyone else said, that there are points in processes where there's no substitute for that face-to-face interaction. But I think there's a balance to be had, and hopefully we can still utilize some of that technology that we've all become very used to over the past 12 months.
Okay, great, interesting stuff. Paul, do you want to give us the next?
Yeah, I'm conscious of time, so this hopefully will be a brief one, but kind of ignoring the pandemic impact, what's sort of new in the marketplace in the Northwest? What new entrants are there in the last 12 months? Stephen, is that something you could pick up on first, please?
Yeah, of course, I'll try and keep it fairly brief. So it certainly feels as a headline that the funding market is as competitive as it's ever been, certainly well served by a real range of options, broad range of solutions. I think I'd probably pick up on a couple of points. Firstly, customer service. I think the experience of the past 12 months has certainly to me highlighted the value of quality customer service and the relationship between funder and borrower. I think those relationships have really enabled that sort of proactive dialogue, whether that's facing challenges and overcoming difficult situations, or actually being able to react quickly to an opportunity that's arisen out of the situation. So I think that close contact and relationship is probably going to be more important than it ever has been going forward. It's certainly clear, I think, that business owners are aware of the options available to them, and I think funders really need to have a pretty clearly defined proposition, and I think an understanding of the specific client needs and that customer service piece really need to be at the sort of centre of any offering going forward. And I think that's a good learning from the past 12 months. In terms of trends, I mean, most of what we've seen recently is businesses wanting to take advantage of the position they have. So whether that's growth or acquisition or MBOs and EOTs, we certainly feel like there's been a pretty heavy rise in those latter two situations. I mean, we've seen a number of our peers adopt the Sybil's option. I think with that scheme closed, it'll certainly be interesting to see how the new recovery loan scheme is utilised, whether actually businesses that were looking for that sort of funding have maybe already got it. And is that just a bit of a sort of a front that's not really needed going forward? But it feels like many businesses have probably got more debt than they'd ordinarily like, with traditional bank and working cap debt plus some C-bills in there. So they're probably at a capacity anyway. So I'd say that risk and credit teams in businesses like ours will certainly be scrutinising cash flows ever more going forward and understanding that debt capacity going forward. And I think that's again something that's come out of those past 12 months. In terms of new entrants, I mean, we're in that sort of 5 to 200 million turnover asset-based space, and I can't really see there's been any new entrants in our space directly in the sort of transactional working capital space in the last 12 months. The only new entrant has been the government-backed support, really, I guess, that's been a bit of a competitor to us. So, yeah, not a very helpful answer on that last bit, unfortunately.
Okay, thanks, Stephen. Jonathan, any brief comments to add?
Excuse me. Just to say that debt isn't the answer totally, is it? We've just heard that debt is available. People have filled up with it. Government funds have been there. I don't think governments are very good at picking winners, though, and doing equity deals. I think the Scottish government's absolutely demonstrated that in recent weeks, and that worries me. We've got bubbles being created, I think, in property, housing, clearly, and I am concerned, I think it was mentioned earlier, concerned that there are inflationary pressures. Now, the normal answer to inflation is to put interest rates up, but all the chat is about reducing them still further, even to negative interest rates. And I just can't reconcile that. I don't know what government will do And I don't know what we do. I think any of us model deals with interest rate variations built in the way that we used to do 10, 20 years ago. Yet that might be a factor if inflation comes through. The only person actually modeling interest rate movements is Rishi Sunak, because he can't afford for them to go up. And I think that's the only factor that will really drive things there. But what does he do about inflation if it starts to kick in? In many ways, governments might be quite attracted to the idea of inflation kicking in and the national debt in relative terms coming down. Now, that's not good for business.
Okay, thanks, Jonathan. Okay, this is my favourite bit, the predictions for the next 12 months. Remembering, guys, this is recorded, so we can play it back in 12 months' time. Jonathan, do you want to go first?
It's going to be staccato. There probably will be fourth and fifth waves. And there is the drag effect of limited recovery elsewhere, Europe, South America, etc., other markets, which will have a drag on our markets, because I think the UK will in relative terms grow very quickly and might even outperform the US in the short term. So M&A, I think, is going to be highly active. We're all going to be very busy over the next 12 months.
That's good. Paul, what do you reckon?
I'd agree with that sentiment. I think various factors and drivers behind M&A activity will ensure sort of the supply of deals will still be there. And then from a funding perspective, there's, as we've heard, there's a lot of capital available to deploy across private equity and private debt markets. There's new fundraising activity in progress, and there's a lot of appetite, and there's a lot of pressure as well to deploy that capital out the door. So I think across the board, I think there'll be good coverage for M&A funding. I do still think there'll be gaps, as it was pre-pandemic. That capital isn't going to be evenly spread across all sectors and markets. So there'll be some winners and some losers, and we might see some of that capital sort of concentrated and chasing some of the same deals. Sort of being focused on the SME market. It's no secret to most that there's a big chunk of the SME market, growing businesses that have historically struggled to access capital for growth. And what we're starting to see as well is a trend of high street bank appetite for SME lending, particularly in the transaction space, and particularly for cash flow lending in general, start to dissipate a little bit, which widens the gap. So in terms of sort of the M&A funding environment, I think there still will be gaps in the SME community, and I think whether that'll be fulfilled will depend on how flexible funders are from a debt and equity perspective. And I think as a result of that, we'll see alternative funders, we'll see challenger banks, and we'll see equity funders becoming more mainstream in the SME space. And we'll see significant market share gains, and we'll probably see new entrants as well, as institutional capital and investors are looking for new places to put their investment. And the SME, is disproportionately a major driver of the economy. So I think we'll see new entrants and new activity.
And I guess the cessation of the C-bills scheme and CL bills is going to have implications, not in the M&A space, but in refinancing, growth, funding, survival. The companies that took on those sort of loans because they had to, otherwise they'd have been gone. There's going to be some issues there to resolve. David, what do you predict for the next 12 months or so?
As I was last time, I'm bullish again this time, which is mainly down to the sort of supply of capital in the market. I think there is, you just touched on it, there's some very short-term pain, and there's going to be quite acute pain for a lot of businesses that have deferred VAT, deferred corporation tax, taken on government schemes, furloughed a whole bunch of staff. So there's going to be some nasty pain coming over the next quarter. But businesses that have been quite robust and not prone to the hard hit sectors, they're quite buoyant, actually. The ones I speak to, they're quite buoyant, and therefore people who work for them haven't had a holiday, haven't bought a new car, and are actually probably saved more than they have. So I think there's going to be one almighty stag do hen party over the summer that we should all relish and love and enjoy. And thereafter, I think that the supply of capital is going to continue. So the M&A market will thrive. The sectors I'd be a bit cautious about, Jonathan mentioned delivery earlier. We see a lot of businesses that are being dressed up as the latest sexy tech thing. Now, they can't all be. They can't all be going for 50 times multiples and all be the best new thing, because they're all doing something quite similar. So I think the whole tech market's got a bit ahead of itself. But I believe, maybe more old economy, and the UK in particular, I think is a really good place to be investing still.
Okay, thanks, Dave. Stephen, what's in your crystal ball?
Yeah, as a relative newbie to these predictions on this panel, I'll probably play a fairly safe one, I think, and turn back to my restructuring days. I mean, I think the market has been expecting an increase in restructuring situations for what feels like months now, and I think that activity is clearly being delayed by the government support measures, and presumably intentionally to sort of smooth the impacts on the economy and potential unemployment that could result out of that as well. So I think that is coming. I think as those measures unwind in coming months, it feels pretty inevitable there will be that increase in restructuring activity, both solvent and inevitably some insolvent as well. But I think that creates opportunities, sector consolidation opportunities for businesses looking for acquisitions, bolt-on acquisition opportunities for PE-backed businesses, or strategic acquisitions for more specialist investment offices. So I think there will be some positive opportunities to come out of that activity. And restructuring inevitably always creates activity in the market, I would say. I think to support this, and I think it's a point that Paul may have raised earlier, is that flexible funding and deliverability and speed being really critical. I think will be key to some of that activity. And I mean, asset-based lending from our point of view certainly can offer that sort of speed and flexibility, and hopefully the certainty around deliverability as well. So I think they'll be quite key.
Okay, that's really good. I'm generally really positive expectations or hopes for the next 12 months from the four of you, which is great. Paul, as in Paul Ellaby, what do you see?
Well, it seems to me, I think, we can take a lot of confidence from what we've heard in terms of how the past 12, 14 months has gone, the way, the market's dealt with some, very challenging circumstances, which I think, kind of at the outset, it sounds like we all thought, it's going to be a problem future for at least the next 12 months. Markets copes pretty well with all of that, and I think we can take a lot of confidence from that into the future. And inevitably, I think there is going to be some bumps along the road in terms of what's going to happen when the government funding is withdrawn. But as I say, I think we can look back and take confidence from the past 12 months. And certainly at the moment, it seems like it is very, very active. So at least for the short-term future, it looks as if activity is going to continue to be strong. Yeah,
and Manchester's well placed, isn't it? Brilliantly placed in terms
Absolutely.
of the whole range of funders, debt funds, private equity, asset-based lending. We're really fortunate in that respect. So that's all good. Sean, have we got any questions? Have we?
We currently don't, but please, anyone who would like to ask a question, you can feel free to type it in the chat box, or as we only have a couple of minutes left, I'm more than happy for people to just come off mute and ask a question. Please do.
Okay, we shall assume that we've anticipated your questions perfectly and answered as we went along. Paul, do you want to wrap up?
Yes, thanks, Jeremy. A few thank yous from me. First of all, to you, Jeremy. This is your kind of concept, and you do a lot of the legwork in terms of pulling it together. So thanks for all your time and effort there. Obviously, thanks to all of our panelists for great contribution. Very insightful, and it's great to hear such positivity. So thanks for giving up your time this morning. A big thank you to the Pro Manchester team, to Nicola and to Sean, without whom we wouldn't have had such a good attendance list this morning. So getting towards 60 people on the call, which is great. Also to Sean in particular for ensuring that this session has proceeded without any technological glitches, which is great. I mean, finally, the biggest thank you to you all for joining in. I think, it's great to have these sort of Pro Manchester events that in the circumstances allow us to kind of maintain that sense of kind of business community. I kind of heard from Sean earlier that there are plans for some real life, face-to-face events during the summer months. And as we've heard from all the panelists, I think everybody's kind of looking forward to that and to being able to get back to some networking and meeting people. And I think, as kind of Dave said in a slightly different context, I think it's so important that, we do kind of have that opportunity to kind of meet and interact in that way. So looking forward to that. And in the meantime, stay safe and stay healthy. Thank you very much.
Thanks, everyone.
Thanks, everyone.
Thanks, guys. Bye.
Bye.